All right, let's dive into it. Netflix just dropped some pretty big news. They're doing a 10-for-1 stock split. And if you're an investor, you're probably asking one simple question: what in the world does this actually mean for my money? Well, we're going to break it all down. So here's the number one question on everyone's mind. Does a 10-for-1 split mean you wake up and your investment is suddenly worth 10 times more? I mean, that sounds amazing, right? The short answer is, well, no. But the real story here, the why behind this move, is actually way more interesting and potentially more important for the future of the stock.
Okay, first things first, let's look at what Netflix actually said. The official announcement gives us all the core details, and it really sets the stage for everything we're about to cover.
So here's the timeline. It's a 10-for-1 split. Pretty simple. If you're on the books as a shareholder by November 10th, you're in. Then, for every single share you own, you're going to get 9 more. Those will show up in your account after the market closes on Friday the 14th. And then, come that Monday morning, November 17th, the stock will start trading at its new, much lower split-adjusted price. Now for the part everyone really wants to understand, the math. So, what is actually happening to the value of your shares? To get our heads around this, let's use a super simple analogy. So, let's get a clear definition up on the screen. A forward stock split. All this means is the company is slicing up the pie into more pieces to make each piece cheaper. But, and this is the most critical part, it happens without changing the total value of the company. The size of the pie stays exactly the same. And this is where the pizza analogy just makes everything click. Imagine your investment is one big pizza. Before the split, you have one share, one big slice, worth $1,100. After the split, you now have 10 shares or 10 smaller slices. Each slice is only worth $110, but when you add it all up, it's still $1,100. You have more slices, but you don't have any more pizza. So the key takeaway here is pretty straightforward. A split has zero impact on the company's total value, its market cap, and it has zero impact on the total value of what you own. Oh, and another big question people always ask is about taxes. The good news? Since you haven't actually made a profit, this is not a taxable event. Pew. And this, of course, leads to the most fascinating question of all. If the fundamental value doesn't change one bit, why would a giant company like Netflix even bother? What's the point of all this? Well, it turns out there isn't just one reason. There are actually 3 big strategic moves happening here. Let's walk through them one by one. The first one is all about pure psychology. I mean, think about it. Even if you can buy fractional shares, a stock price over $1,000 just feels expensive. It feels out of reach. But a price around $100, that just feels more approachable, more affordable. It lowers the mental barrier for new investors to jump in. And Netflix even said this helps their own employees get in on the action with their stock programs more easily. Okay, number 2, it boosts something called liquidity. Now, that's a fancy word, but it just means it makes the stock easier to buy and sell. And why should you care? Well, when there's more trading going on, it can lead to a tighter bid-ask spread. That's that tiny little gap between the buy price and the sell price. A tighter spread basically means you're losing less money to friction every time you make a trade. It all adds up. And the third reason? It's a signal. It's a message. This Reddit user commenting on NVIDIA's split absolutely nailed it. A big split, especially a 10-for-1, is a huge sign of confidence from the company's management. They're basically puffing out their chest and saying, we believe our stock has so much room to grow that we're comfortable chopping the price way down. Now, to really get the full picture, we need to add some context. This isn't Netflix's first rodeo. They've split their stock before, and looking at that history and comparing it to what other tech giants do, it reveals a really clear pattern. Okay, this is where it gets really interesting. History. Now, of course, past performance is no guarantee of future results. We all know that. But look at this. Both of Netflix's previous splits back in 2004 and 2015 were followed by the stock price going up in the short term. And it wasn't just some little short-term bump. That 2015 split, the one that took the stock down from $700, it basically kicked off a period of absolutely explosive growth, a 340% gain in just 2 years. It shows that the split happened right as the business itself was about to hit a major new gear. And Netflix's strategy here is actually pretty unique compared to its peers. You have Apple, who splits pretty often just to keep the price low. You have Amazon, who waited like forever before doing a massive 20-for-1 split. Netflix, though, they seem to use them more strategically, almost like major punctuation marks at key turning points in their growth story. So,
After all of that, let's bring it all back home. What's the real, practical takeaway from all of this for you, the individual investor? Ultimately, it boils down to this. A stock split is a news headline. It's interesting, but it doesn't change the actual business. The long-term value of your investment still comes down to the fundamentals. Are they growing subscribers? Are their movies and shows any good? Are they making a profit? That's what drives the value, not the number you see on the screen. And this number really highlights that fact. Split or no split, Netflix is still considered an expensive stock. Its forward PE ratio, which is just a fancy way to measure its price against its future expected earnings, is 37. That's way higher than the market average of around 22. It means investors are already baking in a ton of future growth. And that leaves us with one last thing to think about. We know the math of a stock split doesn't change a thing. But what about the psychology? Does that powerful feeling of accessibility and that strong signal of confidence from the company, can that actually create its own reality? That's the billion-dollar question. Thanks for tuning in.